What is going on with SoFi stock? It's down around 70% from its recent highs, around 20% below its SPAC deal value. What is going on with SoFi stock? Is this underlying weak fundamentals, or is this more along the lines of weaker sentiment, a changing investment environment? We'll talk about all this and more. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in SoFi. So what's going on with SoFi? You look at it, you see their members, aka customers, are continuing to grow at a hyper rate. 87% growth year over year, 523,000 new customers in the fourth quarter. So their spend on sales and marketing continues to be very effective. Their Galileo accounts, which is really a function of their financial infrastructure products, which is Galileo, that continues to grow very quickly. 67% growth year over year, 100 million accounts, effectively through their Galileo platform versus around 60 million prior year. So first, a quick take. This means to me, when you're seeing something like this, you're seeing this type of hyper growth. Two different data points to consider. One is the banking sector growing this quickly? No way is the banking sector growing this quickly. So then it forces you to ask, okay, so they're taking market share. That's what this suggests, because they're growing so much faster. But it forces you to ask yourself, at what cost and how are they doing it? And so is this because they're unrivaled and they just have a better product, or is this because they're significantly unprofitable and they're investing a lot in sales and marketing? And we'll see whether or not that results in long-term customer relationships over time that results in profitability. So let's look more into their financials in a second. But you look at what they've done in the last few years, and you got to give management a lot of credit here. Seeing nice revenue growth, 60% plus revenue growth in 2021. Continuing to get towards heading in the right direction with EBITDA. Getting to break even plus, now at 30 million positive adjusted EBITDA in 2021. So look, you got to give management a lot of credit here, because with a lot of SPACs out there, they set high bars and they completely whiff it. They go way under. This is one of these companies that says, hey, we're going to set a high bar for ourselves. And sometimes they beat it, sometimes they're in line with it. So they've done, I'd argue, a great job since coming out, saying, hey, here's our lofty expectations for ourselves. Let's try to deliver on it. So management should get high marks for putting out high targets and delivering on it, in my opinion. So now you look at it and say, actually, what's driving this business? And the reality is it's three different segments: lending, technology platform, financial services. Lending is generating around 399 million in contribution profit. Contribution profit we'll talk more about in a second. Just for the time being, it's a way of thinking about how much sort of high-level profitability are you generating from these different segments. This does not translate into actual company profitability, which we'll walk through in a second. But they're saying lending is around 400 million. This Galileo, financial infrastructure is only 64 million in contribution profit. So you can tell it's not really anywhere near the same scale as lending. Lending is really important. Financial services, which is around, offering new financial products to users, like credit cards, like savings accounts, like investment accounts. This is still way subscale, generating significant losses. So that is worthwhile to understand. Oh, okay, the core value of this business, maybe if you just focus on this, should be higher because you are generating a loss here. But, it is worthwhile to understand, okay, how does their business model actually work? If the vast majority of their value is coming from lending, and you have this non-interest income of around 500 million and net interest income of around 260 million, really what that means is you have effectively two different forms of benefiting from underwriting new loans. On the one hand, you can keep the loan on your books and you're collecting that interest income from the interest on that loan. You underwrite a new student loan, you're collecting the interest on it. The non-interest income, which is the bigger piece for SoFi and a core part of their business model, is that they originate a lot of loans. They're going to spend a lot in sales and marketing, bring folks to their website. Let's say someone wants to refinance their credit card, say, hey, I'm not happy with this credit card. Let me just do a personal loan at potentially much lower rate. And then what SoFi does is they take that loan, they securitize it. They then sell it to other folks in the financial industry, saying, hey, I'm happy to have that loan. And SoFi gets a cut. They get effectively a fee for selling it. And that's the vast majority of the revenue at this time. So you should understand that this business is tied to how much business can they originate over time. And when it comes to originating, you could see the vast majority of their origination growth in 2021 was tied to personal loans. Over 100% growth, around $5 billion worth of personal loan originations in 2021. This is more than both the student loans and the home loan space. And once again, the key aspect here, you can see it on their website. The key aspect of this personal loans is that it's supposed to be made easy. It's more affordable than, let's say, compounding high interest credit cards. You can get the funds that very day. It doesn't necessarily affect your credit score. And you can get somewhere between $5,000 and $100,000 from a personal loan. So that's the appeal. That's sort of what they're targeting. Now, part of the reason, even though they're posting this significant growth and you're talking about significant contribution profit with these individual segments, the reality is that there is still very real expenses with this business that aren't captured on this contribution, measurement on a segment level, and they do have significant share-based compensation, effectively employing and paying their employees around $240 million, employee-related costs another $140 million, other corporate and unallocated expenses another $167 million. So the reality is this company is still very significantly unprofitable, and this is part of the reason I'd argue that SoFi stock has come under pressure, is that we are arguably in a new environment where previously companies that were not yet profitable were getting full credit for their future results. Now we're in an environment where folks are saying, hey, you know what, I'm a little more skeptical. I want to see the underlying profitability. We'll talk about more of that changing dynamic in just a second. But the reality is, talking about significant contribution profit is nowhere near their underlying economics, as they're still significantly unprofitable. Now, management is targeting continued hyper growth in 2022, 55% growth in 2022 on an adjusted net revenue basis, saying, hey, we think our EBITDA margins can expand significantly from around 3% to 11%. That would be great, to around $180 million in adjusted EBITDA. But once again, this is still, you might think, oh, this is a great metric, but this is the reason why Buffett and Charlie Munger routinely talk about how EBITDA is a BS metric, and it's because it's not truly reflective of the underlying economics of the business when you have something like $340 million in stock-based compensation that's getting added back to make this positive 180. The reality is this is a real expense. It's effectively diluting the existing shareholders. So the reality is you are still significantly unprofitable, and so it still has some time to go before you're looking at a truly a self-financing, a business model where you're like, wow, this is a profitable and lucrative business model. Now, they also did complete an acquisition of Technisys, which is adding to their Galileo platform. This is a one-stop shop financial services platform that they're targeting, talking about enhancing the Galileo business, and this is part of their overall pursuit to build the AWS of fintech. So that's a reference to Amazon's server business, their cloud infrastructure, and they're talking about the value add from acquiring this business is potentially adding a cumulative 500 to 800 million in revenue through 2025 at high incremental margins. So saying this could be significantly profitable business over time. This is really getting their foot more through the door for financial infrastructure offerings in Latin America. So this leverages what they already have with Galileo, combined here with Technisys, expands their offering into Latin America. And the question is then, at what price are you paying for this offering? It's all good and well to say, hey, there's these great companies we want to acquire. But the reality is they're using a lot of stock to buy this. They're using $1.1 billion worth of SoFi stock in order to buy Technisys. And so paying around $1.1 billion on, let's say, an adjusted $120 million in adjusted revenue, that's a ballpark figure, because here it is. They talk about the estimated incremental revenue from the acquisition, including base revenue of Technisys and revenue synergies. They're saying cumulative 500 to 800 million. So that's how I'm getting around this 120 million, just ballpark figure, because you're thinking it's spread over 4 years. And so let's say 120 million versus this 1.1 billion in stock, that implies around 9 times sales. And so this is worthwhile to understand that management is using, effectively, they're using their stock as currency to buy things. And so then it becomes a question of, is this smart capital allocation? Is this potentially at a good deal? And that I don't have a super strong opinion on. I mean, it does certainly weigh down the stock, and that is another aspect that could be holding down SoFi stock is as you increase the supply of shares outstanding, it could hurt the stock. And it is worth calling out that, this deal value is likely, around or at a premium to SoFi's current valuation, or around, its current valuation. So it's not like, you're getting a steal here where you're buying it at like 3 times sales. So that is worthwhile to understand. Okay, so now, you're looking at SoFi stock now that it's trading around 20% below its SPAC deal value. What does this mean? What does this environment suggest? Once again, going back to that question, is this fundamentals? Is this sentiment? And so I look at this and I say, this is SoFi is sort of like a case example of how sentiment has changed, how you are now in an environment where you need to see companies generating true economic profits and saying, hey, this is our path to not only our current profitability, but this is how we're going to expand it over time. And you see this sort of aspect, and SoFi did sort of the no-no of issuing common stock when the price was arguably already selling off. And so that sort of gets worsened. It worsens the stock price decline as the stock price starts selling off. And then you're saying, here it is, stock price starts selling off. And then you're like, oh yeah, and this deal will be valued based on this new share count. Oh, so you have even more shares outstanding. So it's, you issue the shares here, or the deal values based on shares here. And then yes, if you're going to issue another $1 billion worth of shares to cover a transaction, yeah, increase supply, and it might just, continue downwards. So I would say this is a perfect example of how market sentiment has changed. We are arguably in a new world where you want to own businesses and this is the traditional Warren Buffett approach, is like, look, he owns businesses that have already proven their unit economics. And so, for example, look, if you talk about, AWS, for example, Amazon Web Services, and they say, hey, we want to be the AWS, of finance. The reality is that AWS has 30% profit margins, and they've had that, like, real profit margins, not adjusted, phony baloney adjusted EBITDA profit margins, real 30% profit margins. And they've had that for several years now. And so you look at this and you're saying, oh, okay, well, you need to, if you're going to call yourself the aspirationally the AWS of finance, you're going to need to show it with real profitability over time. And so they're not there yet. They're getting a discount because of that. And so I think that's an aspect that investors need to consider as you're looking at this. This is a business that's still significantly unprofitable. That contribution profit of around 60 million for their Galileo or their financial, infrastructure segment, that is pretty small relative to their lending business. Now, their lending business, which is around 400 million in that contribution profit. And so their lending business raises a whole bunch of other questions and concerns that investors need to consider. Because, on the one hand, you still see this business that's unprofitable on a consolidated basis, and you're saying to yourself, what does the economics actually look like for this business long term? And so you want to say, what does the true profitability look like before valuing this? And so that is part of, I'd argue what gets into the discount here. And that's part of what's holding me as an investor from pulling a trigger on SoFi. I want to see, yeah, you're growing faster than the market. You're clearly taking share, but are you able to do that on a sustainable basis? And if the opportunity is so big for you and you're going to be able to do this for years, let's say decades in the future, then at some point, let's say in the next 5 years, you'll be able to prove the unit economics, and then it'll be early enough. Then I could ride the next, after 5 years from now, you've proven it, then I can ride 5 years on. But for now, that's a little bit too hard for me because you haven't proven it. Then you layer on this aspect of economic cyclicality. And you say, well, wait a second, how does this business perform? How does their personal loan book perform in an environment where, let's say there's an economic shock where oil prices jump higher and people say, wait a second, I need to pay my gasoline bills, I need to pay my electrical bills, and I don't have the money to cover this personal loan. How does that segment perform in that environment? So I'd say you're also getting sort of this uncertainty discount with something like SoFi, where folks are sort of saying, wait a second, this is a financial business that's going to be cyclical. It's going to be tied to the underlying economic cycle. Now, they have grown very quickly, so it's possible they're able to grow right through it. But let's see. I personally want to see how they deliver on really two fronts. I want to see how they deliver through the economic cycle. What happened with COVID? That was sort of like a very short, jarring experience, and management reacted very quickly. Like they said, okay, student loan moratorium, that's a problem. So let's offset with personal loans, and, we're going to grow really fast there. So once again, give management a lot of credit to adapting. But I would say as an investor, I personally want to see, how do they perform through a full economic cycle? Rate tightenings, recession, a weaker consumer spending, combined with how does this business do? What does their long-term economics look like? And can we actually prove? If you're going to call yourself or aim to be the AWS of finance, are you actually at 30% plus profit margins? And that's personally what I'd want to see before pulling the trigger. And it's okay. I don't have to buy at the bottom tick. It's okay. Like I can miss it. Now, some people, might consider doing a speculative position, and I'm not saying, hey, you shouldn't do that or something like that. It's just not for me personally. For a situation like this in the environment that we are now, I'm personally holding off. I'm personally looking for companies that, let's say maybe they're slower growth, but they're profitable. They've proven their business model. That's something that I would consider making a larger allocation. Something like a Sofi, it would be a much smaller allocation for me, where I'm saying, hey, this really hasn't proven itself. Maybe it would be a teaser position for me. I'd buy on really weak sentiment. If the stock price were just to fall, fall significantly based on underlying fears of a recession and things like that. But once again, at this point, I would not have the conviction to say, hey, this should be a large position, given that you really haven't fleshed out the underlying unit economics. And if you have a different take on this and saying, Daniel, this is why I'm a strong believer in Sofi, and why I think their profitability can be X% margin, and why I think they'll be significantly profitable in the years ahead, and why they can weather any sort of economic storms, in the future, I'd love to hear it. Feel free to, discuss in the comments below. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.